Hello students, this is Professor Faiz Raut from Jain College of Engineering, Department of MBA. Welcome to third semester or the second year of your MBA. In this semester, I'll be teaching you the financial specialization subject named as Banking and Financial Services. Okay, in this subject in Banking and Financial Services, it's a 90% theory subject and 10% problems. Okay, 10% in the sense one type of problem you will get in your examination for the case study compulsory question. Okay, rest everything will be theory. Okay, that one type of problem will be related to leasing, whether a company should lease a machine or should buy the machine on loan, or which is the better option. And another type of problem will be regarding hire purchase. So two types of problems are there, leasing and hire purchase. From those two types you will get one type of problem in your examination for your case study, compulsory case study. Okay, so apart from that, rest everything will be theory related to banking and financial services. In the first and the second module, okay, you will be dealing with the banking operations in India. Okay, the banking and financial services will be related to the Indian economy. Okay, the Indian banking structure, the Indian financial services. So first and second module will you will be encountering related to the structure of banking in India and what is commercial banking in India. So till what is NEFT, RTGS, till that, what are the primary, secondary functions of the commercial bank, what is RBI, what are its roles and responsibilities, and what are the functions of RBI, what are the functions of banks. All those things you will be dealing with in first and second module. Whereas in the third, fourth, fifth and sixth module you will be studying the other financial services. Okay, like in third unit, merchant banking is there. Okay, we'll be studying also a part of investment banking services. Then we have NBFCs, non-banking financial services, in the fourth unit. In that fourth unit you will be having problems which I mentioned earlier related to leasing and hire purchase. And in the fifth module we'll be studying regarding the credit rating agency, the agency which rate the company on the basis of their financial strength, and depending upon that rating they can apply for the loans. Okay, so A rated company will have a strong financial position, whereas a C graded or a B plus or C plus, C minus, like that gradings are there depending upon which agency that company has applied. So a graded company will have a strong financial position, C graded company will have not so strong financial position. So when the banks are offering loans to those kind of companies, they will do it according seeing the rating of those companies. Okay, and the credit rating agencies in India are well known are CRISIL. Okay, they rate companies. Okay, which is also if globally, if you see S&P 5, S&P is there, Standard and Poor's, and Moody's ratings are there. Okay, and Fitch rating. So these are the three main companies which are well known throughout the world. There are credit rating agencies. We'll study in detail. Then we have in unit 5 venture capital as well. So venture capital, I guess you must have studied some part of it in the entrepreneurship development in the second semester. So you will be dealing with these stages and just a small introduction in the stages and performance of venture capital in India and how it is related to the banking and financial services. Okay, and last module we will be having mutual funds. Okay, so meaning, process, who are the depositories, and what is NSDL, what is CDSL, what is clearing and settlement, what is factoring and forfeiting. So generally it is not only mutual funds, it is related to mutual funds as well as the how the clearing process takes place. Okay, one person is having some shares, another person needs those shares, and one buyer is buying those shares and seller is selling those shares in exchange of some money. How that entire process goes through, how the broker gets involved, how the depository participant gets involved, how the exchanges get involved. Okay, and all that process we'll be studying in the sixth module. Okay, so this was about the introduction of this subject. Well, in module 1 you will be studying the structure of banking sector in India. So in this you have functions of RBI, structures, functions of commercial banks, what is a monetary system, what are the sources of funds, quantitative and qualitative measures of credit control, which the RBI does. It keeps on regulating and keeps on doing these measures, quantitative and qualitative measures in the economy to take care that there is less volatility in terms of monetary benefits or monetary dealings in the economy, and banking sector reforms and bank performance analysis and future of banking is also there. Okay, so let's begin with the first one, which is Reserve Bank of India. Well, when you hear the term Reserve Bank of India, one thing comes to your mind is the biggest bank or the bank which controls all the banks. Okay, so more or less you're right in that case. Well, Reserve Bank of India, okay, is the central banking authority of India. Okay, most or almost all the banks come under it, and it regulates all the banks depending upon where they are situated and how much is their capitalization, and although how the interest rates will go on, and what are the other benefits need to be given to the society and all those things. So they are the only the main control body of a country. So as we have Reserve Bank of India, we also have central bank, which is the central bank of United States. So similar to Reserve Bank of India, which is the central monetary authority of India, we have central bank, which is the central monetary authority of United States. We have Bank of England as the central banking authority of England. So in major economies of the world, they have one central bank who regulates all the banking system and the money flow in the economy. So here we have Reserve Bank. Well, it was established in 1934, just before independence. Okay, maybe 12-13 years before independence, but it started its operation in 1935. Okay, the main rationale why it was meant was in order to generate, maintain, promote confidence and trust in the people in the banking system. So in those days in 1934 and in those period, people used to keep money or hoard golds into their lockers, tijori, they used to call, in the lockers and tijoris in their homes. So they didn't trusted the banking system, so they didn't deposit the money or the gold in the banking system. So the money was kept idle in homes. So to promote the confidence, this Reserve Bank of India was established. And to protect, second is to protect the investors' interest by timely disclosure by the institutions and access to the information by the investors. Okay, so that investors will be feeling the confidence in order to invest and to explore explore the financial services and invest money in the markets. Okay, and third is to ensure that the financial markets are both fair and efficient. Okay, so this is the main thing, very important thing. Financial markets of any country drives the economy. Okay, they are one of the important factor for to drive the economy in upward direction or in downward direction. So it is very important to make fair and efficient dealings in the financial markets as well. And next is to ensure that participants measure up to the rules of the marketplace. Okay, the participants in the financial systems, the banks, the borrowers, the lenders, the intermediaries, all follow the rules of the marketplace. Okay, so that it ensures it, the RBI. Okay, whether if I want to say the objectives, why RBI, what RBI does. Okay, as I told you, RBI was established in on 1st April 1935. It started functioning basically. It was established in 1934 and started functioning in 1935. But as we know RBI now, what are the powers and what are the control RBI has nowadays, it was not similar to that. Okay, which was there in 1935. In 1935 and in those period, RBI didn't had too much control. Okay, and when the Banking Regulation Act was passed after independence in 1949, it was passed, then RBI started gaining controls, and through the course of time in 1960s and 70s, RBI got much more powers and became much more strong. And so the banking and the economic sector of India was very well dependent on RBI. Okay, so but what are the main objectives as of now? To maintain the monetary stability such that the businesses and the economic life of the country can deliver the welfare gains of a mixed economy. Okay, as we have studied in the second semester in legal and business environment, the monetary stability, the monetary uh, policies which are made, which will be made by the RBI, and the fiscal policy were made by the government. So in order to maintain the monetary stability, and also in order to improve the economic life of the country, okay, RBI does takes steps. Okay, so the main objectives of the RBI includes this, to gains of a mixed economy. Also, you know what is a mixed economy now. Okay, a mixture of socialism and capitalism. Okay, the second is to maintain financial stability and ensure sound financial institutions so that economic units can conduct their business with confidence. Okay, financial stability is also very important, because if banks are have given loans to some industries and to some individuals, different kinds of loans, if those banks are unstable, then people will not have any confidence. If those banks started going bankrupt, or if those banks started closing down and they are running away, or some fake branches are opening up, NPA, non-performing assets, are increasing in the economy, then people will lose confidence, the businesses will lose confidence. Okay, so in order to maintain that financial stability also, it is a role of RBI. Third is to maintain stable payment systems so that the financial transactions can be safely and efficiently executed. Okay, obviously the payment system should be very much stable. If we are transferring some amount to that person should receive the amount. Okay, we have seen, you are aware with the NEFT and the RTGS process and IMPS nowadays, what we do through mobile, and other payment gateways are also there, which ensure stable payment systems. So RBI ensures even that. Then fourth is to ensure that the credit allocation by the financial system broadly reflects the national economic priorities and social concerns. Okay, to ensure the credit allocation. Okay, so properly the credit has been allocated to the financial system. Okay, this the banks, which the banks should give credits even to all the sectors. Okay, they should not give only to one kind of a sectors. For example, only for home loans or for car loans, they'll avoid the agricultural loans. So nothing like that should be done. Okay, a proper allocation should be done of credit. And fifth is to regulate the overall volume of money and credit in the economy to ensure reasonable degree of price stability. Okay, the volume of money is also being regulated by the RBI. Okay, so they increase the interest rate, they decrease the interest rate, they increase the repo rate, reverse repo rate, increase the CLR and SLR requirements of the banks. They do all those stuffs in order to regulate the volume of money. So the volume of money should not go very high, because if the supply increases and the value of that money start decreasing, and it should not go low also. So the cash which is circulating in the economy should be very much under control. So this is the also objective of an RBI. And final objective is to promote the development of financial markets and systems to enable itself to operate or regulate efficiently. Okay, so financial markets, as I've told you, it's very important. So it promotes the development of those financial markets, so that many people come and invest in these financial markets, and in turn help to grow the economy as a whole. So these were the main objectives of RBI. Okay, so this is how an RBI is formed. Many banks come under it. The RBI is giving directions to all the banks. Okay, so if any banks are shortage, have shortage of money, then they can borrow from RBI. Okay, using repo rates. Okay, the repurchase options. We'll do this in detail in the further slides, or maybe in further units as well. Okay, so this is how an RBI. You just need to imagine, when you are imagining RBI, you are imagining a central authority who is controlling every financial activity, every financial every financial sector, in the entire financial sector, whoever the participants are there, whoever are borrowing money, whoever are lending money, everything RBI is monitoring it. Okay, so the functioning of RBI in the next slide is the foremost function is it is the sole currency authority. Okay, sole currency authority means the currency which is being printed, the notes which are being printed, 10 rupee note, 20 rupee note, 100, 2000 rupee note, all those notes, how to print them, circulate them, and the coins as well. So and any counterfeiting measures also is being carried out, so that the notes cannot be copied by anyone. Okay, so though what do you say, the security protocols are being followed exactly, how there are certain what do you say, security things which are hidden in the notes, which you can identify whether it is a real note or artificial note or a counterfeit note. So you can identify that. So all those things is being controlled, and it is the only authority which does that, RBI. So the main in India, the main printing center is in Nagpur, which prints the notes. Okay, and it is being circulated. Okay, well, so printing of currency notes, clean note policy. That means it will dispose of the old notes and print new notes in the market. Anti-counterfeiting measures. Okay, computerized operations, and coinization of lower denomination notes. Okay, or making coins as well. Then second is banker to the government. Okay, now government has a budget. Okay, that budget can exceed if any calamity takes place or any new projects is being passed. Then sometimes government also needs money, so they are during the shortage of money crisis with the government, this government can approach RBI. As I've told you in the previous semester, the fiscal policy which has been made by the government, the main income of the government is through taxes. Okay, so if there are less taxes and more work to be done, more money to be spent, then the over budget will be there in the fiscal policy. So and during that time, government approaches RBI to borrow some money. Okay, as both are different, RBI is different, government is different. Okay, so RBI lends money to the government. So the RBI is acting as a bank to the government. That's what the second part says, banker to the government. Okay, central government can borrow money, state government can borrow money, and that will be borrowed. Definitely there will be some interest rate, and after certain years or certain time period, the government will return that money to RBI. So it is a kind of a we can call it as a banker to the governments. Okay, then third one is banker's bank and lender of last resort. Okay, and this says that there are many banks in India. Public sector banks are there, private sector banks are there, many branches are there. So suppose, okay, I'll give you an example. There is a federal bank in Tilakwadi. Okay, and there are many depositors, many borrowers also. Okay, now once many depositors come to this bank to withdraw their money. Okay, it's a demand liability to the bank. That means depositors have deposited the money, they can withdraw money at any time. So suppose many depositors are coming to withdraw their money, and federal bank is short of money. So what it will do, it will ask the head office. Okay, this branch will ask the head to provide some money. Okay, suppose it receives money and give it to the depositor. Suppose that head office doesn't have the money to give to the branch, then the head office will approach RBI. Okay, first it will approach to another bank. Okay, so maybe Kotak Mahindra or ICICI. they will also give money. Generally this money has been given in the terms of loan only, okay, with interest. So it will approach Kotak or ICICI or any other bank. Suppose if even they don't have any money, so finally the head of federal bank will go to RBI and ask money from RBI. Then RBI will also give loan to the federal bank. Okay, so if people are coming to withdraw their deposits, if that branch doesn't have the money, it will ask its head. If the head doesn't have money, it will ask other banks. If even the other banks are not providing or don't have money, then finally that person will go to the RBI to borrow money to give it to the depositor. So this chain goes from the depositor to the RBI if any of the intermediaries don't have money. So RBI is the last person which the banks will approach in order to get money. Okay, so that's why RBI is called as a lender of last resort. Akhir mein they will go to RBI and they will withdraw money, and RBI is also acting a banker to the banks. Okay, so it is acting as a bank for the federal bank, RBI. Okay, so it is also called as a banker's bank or lender of the last resort. Okay, so this was about the third one. Fourth one is the controller of money and credit. Okay, there are many the money is being circulated in the economy. There is hard cash, there is what do you say, the numbers which you see in your bank account. Okay, that money you have. Okay, so everything is being controlled and monitored by RBI. So RBI takes care when this money is being circulated properly. Okay, there should not be a too much cash or too much money in the economy, so that the supply of money should not increase. The supply of money should not decrease as well. The supply of credit should also not increase, because if many banks are giving credit at a very high or low interest rate, whatever the interest rate is, but they are giving credit very much to the in the economy, then it is very risky in the terms of increasing the NPAs. Okay, if non-performing assets, if the loans are not paid back to the bank, then NPAs will increase, non-performing assets. Okay, I guess this is the new term for you. I'll explain it in the further slides. Okay, just to give a hint what it is, the loans which is being given by the bank to the borrower, okay, to the person or to the company, that is an asset for the bank, because that money will come to bank with adding some interest. So that is an asset. If that asset doesn't come back, if that person doesn't pay back the loan, the company doesn't pay back the loan, then that asset becomes non-performing, and that is a loss for the bank. And if that person gets run away, or the company close downs, or something happens, okay, then it is a loss for the bank. So that non-performing asset should not increase by the bank. Okay, it should be under control. So finally the control who takes? RBI takes. So they monitor how the credit has been given and how much is the non-performing assets of those banks are there. Okay, so all this controls is being done by RBI using quantitative credit controls and selective credit controls. Okay, what is quantitative credit controls? They will do in the terms of CRR and SLR and moral suasion as well. Okay, what is this CRR? CRR is the cash reserve ratio which each bank needs to keep with RBI. And what is that cash? Whatever the depositors have deposited in the banks, a percentage of that money should be deposited by this bank with the RBI. Okay, and SLR or statutory liquidity ratio is the money which the RBI tells this bank in order to invest in some securities which are very safe. And moral suasions means RBI will influence the investment or the credit policies of the commercial banks. They will tell whether to give or not based on their understanding. Okay, to explain this with an example, if there are 100 crore rupees with a bank, okay, as the deposited money from the depositors, so from that 100 crore rupees, the bank cannot lend 100 crore rupees to the borrowers. Okay, from that 100 crore rupees, some of the money, okay, maybe 2.5 to 3 in that ratio, from 100 we'll take it as 3%. Okay, so from 100 crores, 3%, okay, all 3 crores rupees will be given by the bank to RBI. That amount is called as the cash reserve ratio, and RBI will not use that 3 crore rupee. RBI will keep that 3 crore rupee as a CRR deposit from the bank in order to use if that bank fails or something bad happens to the bank. So it is a kind of a fund which has been kept by the bank with the RBI. Okay, so cash reserve ratio is somewhere around 3%, 3.2%. This keeps on changing depending upon the economic situation and how the RBI wants to control the monetary policies of the country. Similarly, SLR is the amount which the RBI suggests the banks. You invest here, this is a good security, keep your money invested here. Okay, something like that. So it is somewhere around 21-22% SLR. So these also keeps on changing. So from that 100 crores, 3% or 3 crores we have kept as CRR with RBI, and rest 21 crores we have invested in the some securities as SLR. So out of 100 crores, 21 plus 3, maybe 24 or maybe 25% or 25 crores we have kept aside. Rest 75 crores the bank can use it to give loans. Okay, so this is how a quantitative credit control is done. We are going to deal with this in very great detail in the further modules. Okay, the next is selective credit control. It controls the credit flow in the economy, how it uses some margins. RBI gives a range of, suppose you cannot give what do you say, the interest to the depositor above this or below this number, like 6.5% or 7% is the maximum interest you can give to the depositors. Okay, so like that margin can be made by the RBI, a ceiling can be made by the RBI. Okay, above 7% no bank can give. So as of now, I guess Kotak is the bank which is providing highest interest to the depositors, around 6.7 to 6.5, somewhere around that. So more than that no bank provides. So there is some kind of a ceiling. Okay, uske upar you cannot give any interest to the depositors, and there are also certain ceilings and certain margins kept for the loans as well. So above this interest rate no one should be given loan, or below this interest rate no one can avail loan from the banks. Okay, all this kind of a credit controls can be done by RBI. Okay, so next time we will study about the regulatory and promotional roles of RBI. Okay, so well, thanks for listening. Okay, well, this is quite a simple module. Okay, we'll complete it soon. Okay, thank you for listening.